Welcome to another Wall Street Informer production on WSI TV.
Hi guys, Sean Bauer here, Chief Editor of Wall Street Informer on wallstreetinformer.com. Thanks for joining me for another episode of WSI TV. And once again, we're going to delve into the topic of options trading. Now, options are really the biggest profit accelerator available on Wall Street and pretty much any financial market there is. And as we showed you in the last options video, and you go back and check that out on the WSI TV YouTube channel. As we showed you there, the massive leverage you get from options is really where you accelerate those profits and where you can turn 10% gains into double your money trades. That just really can't happen anywhere else. But what we want to do today is continue down the options topic and really get into reading an options table, some of the terms you need to know, and just certain ways that you can navigate options in a world that can be very complex if you don't know what you're doing. We're just going to simplify it by showing you exactly what you need to know and nothing else so that you can, like I said, properly navigate this world and turn those small trades into big, big wins. Okay, so in just a moment, we're going to go over some of the main terms you need to know to read an options table and what they mean. And then live on my screen, we're going to go through a live options table so I can explain in real time exactly what you're looking for. That's why I'm recording this WSI TV episode straight from my desk right now. But before we get to that, I think it's smart just to go over the very basics of options. This is some of the stuff we covered in the last WSI TV episode about options, and it's sort of going to set the stage for us to continue on with this conversation. The first thing we want to know is that there are two types of options, a call option and a put option. We're going to focus on buying for the first few episodes that we're talking about options just to make it simpler, and we'll get into selling a little later on. But let's say that you're going to buy a call option. When you buy a call option, you want the underlying stock to go up. That's how you're going to make money. And the opposite is true for a put option. When you buy a put option, you're betting that the underlying stock is going to go down. Simple enough, right? Now, for some more of the basics, we know that one option contract is 100 shares. It controls 100 shares of the underlying stock. So if you say, I want to buy one call option for Microsoft stock, you're really controlling 100 shares of Microsoft stock in that one options contract. That's where this massive leverage comes in. And like we mentioned before, the great thing about options is that you get all of that leverage, but you know the total potential downside risk is just what you paid for that option. So if you pay $200 for a call option, all you can lose is $200, but what you can make is 10 times that. It's really infinite. But you'll see how it's very legitimate and reasonable to get 50%, 100% gains just from one option contract. The second thing is that you're going to pick the expiration date for the option. And if you pick December of 2016, the expiration is going to be the third Friday of the month. So it's always the third Friday of the month, unless you buy a unique option. But we'll get into that in a later episode. Anyway, you pick the expiration for the option. And if I'm going to buy Microsoft stock today, I can either say I want it to expire in October, which is this month, or it can expire in November or December or January 2017. And based on what expiration I pick, that's going to affect the price of the option and my potential gains. Now, the last thing we want to talk about is that the value of the option is determined by both the movement of the underlying stock's price and the timing relative to your expiration date. And we'll see as we go through more examples just exactly how this works. But it's a combination of timing and price movement that's going to make your option really worth, that double your money type of trade. But let's go ahead and get into some options terms. Now, like I said, I'm going to show you a live table in just a minute. But the first term you need to know, and there are actually very few that you really need to know. The first one is the ask price. Now, this is what a market maker is willing to sell the option in question at. So if you want to buy a Microsoft call option with a strike price of $100, you look for the ask price, and that's what a market maker is willing to sell that option at. So all you really need to know is that in essence, the ask price is the price at which you're going to pay to buy the option. And that's at market value. And we'll show you a little trick to get a little bit better pricing, but that's really what you need to know about the ask price. Now, the bid price is basically the opposite. It's the latest price offered by a market maker to buy the option in question. So from your perspective, the bid price is where you would sell the option, and that's for market price once again. Now, the third out of just 4 terms that you need to know on an options table is the strike price. And we talked about this a little bit last time, but the strike price is something else that you pick whenever you're going to buy or sell an option. And the definition in this context is the price that a buyer of the option can purchase the underlying shares of whatever stock at if the option is exercised. Now, it's also the price where the seller of the option must sell the underlying stock shares if the option is exercised against him. What this is going to show you when you are going to be in the money or not, and we'll look at that a little bit closer when we get to the live options table. But for now, you just need to know that the strike price is what you pick, and that's where, if the option's exercised, the buyer is going to purchase those shares at. Now, the final term you really need is the volume. And just like anything else, it's just going to show you the amount of trading. Now, for options, it's just showing you the amount of contracts for a particular option that was traded during the latest session. So it's not going to go back a huge time frame. It's just the latest session of trading. And here is finally the goods. This is the real stuff. This is an actual live options table, and this is where you would go to put in the information you want to actually make an options trade. Now, here you can see at the very top, and please don't let all of the stuff on here confuse you. We're going to be using just a few bits out of it to get exactly what we want. But the first thing you're looking at is up here in the top left, the symbol. And obviously that's just the stock ticker for whatever stock you want to buy an option for. Now, the range can either be near the money or all. You're usually going to pick near the money trades, and that just puts the strike price near the actual price of the stock. For type, right now we have calls and puts, so we're going to see both the calls on the left-hand side here and the puts on the right-hand side. And you can select if you just want to deal with calls, you can just look at one of them. And then the last thing is the expiration. Now right here I just have plugged in December 16, which again would be the third Friday of December. But as you can see, there's a huge variety that you can select from. And I can go as far as January 19 to buy a leap, which is just a very long option. But we're going to stick with this right now as we have it, so we can look down and see exactly what's going on right now. Okay, so let's focus on calls on the left-hand side here. As we already mentioned, if you're going to buy a call option, you're betting on the price of the stock to go up. So let's go ahead and look at first the bid here. Now remember, that's the sell price for you. That's what a market maker is willing to buy at. And here is the ask price. That's what a market maker is willing to sell at and what you will be buying at. Now the difference between these two is called the spread. And that's really where market makers make their living, make their money. Now what you want as an option trader is a tight spread. And as you get more acclimated, you'll see what looks like a tight spread, what looks like a wide spread. This one is relatively close. This is a nice spread. It's $8.35 for the bid, $8.50 for the ask. And as we'll show you later on, we'll show you a trick to make sure you're getting at the best price. But let's say that you're going to go ahead and buy this top call option for Apple at $8.50. Now remember, since there are 100 shares that you're really controlling with this option, that 8.50 gets multiplied by those 100 shares. So the actual price of this call option would be $850. Now, as you can see, if you just come down to this next one, it would be $525, and so on and so on. And the reason for that difference is right here, the strike price. Now you can see this for this top line, the strike price is $110. And that's why it's so expensive. The price of Apple right now, the actual Apple stock, is $116. So because it's already in the money with the strike price being below the actual price, that's going to push the price of the option way up. Now even this $115 strike price option is in the money, so that's why this is a little more expensive than the ones that are out of the money. And that's where these highlighted bars come in. You can see, just looking at the call side, the two top bars are highlighted yellowish because those are in the money. The two on the bottom here are just blank white. That's because they're out of the money right now. Because the strike price 120 there is higher than the actual price of Apple stock right now. And that's why they're a lesser price as well. Now the other thing we wanted to get to is the volume here. Now the volume, like we just mentioned, is the number of contracts traded just in the last trading session. And Apple, as you would imagine, as a very popular stock, has had a ton of volume here. That's a ton of trades. And that's why you see some very, very tight spreads over here. So 2.88 and 2.90, that's about as close as it's ever going to get for an option. And that's what you really want to see as an option trader. Now all you have to do to go to the other side, the puts here, is either select puts up in the top or just go to the other side. And this is if you want to buy a put because you think Apple stock is going to go down. Now the only thing that really changes here is that the in the money stuff is going to be the strike prices that are higher, because since you're betting on it to go down, this 116 real-time Apple stock price has to be lower than the strike price. And you can see that the 110 strike price put and the 115 strike price put, those are both out of the money because the price of Apple stock hasn't dipped down to that level yet. And you can see how the prices work inversely to calls as well, which makes perfect sense since they're opposite trades. Okay, now all we're doing is focusing in on the call side of the option table. You can still see it's the same December 16 calls here, and you can still see the strike prices lined up in this blue bar. Now what I really want to show you is just looking at the prices, how quickly they can turn into big gains for you. So just focus in on the two in the middle. Now the one that's in the money now, the $115 strike price call, that's already going for $525, which you get by that 5.25 times 100 shares. The one that's next, that's just out of the money, is this $220 strike price, and that's just $2.90 or $290 for the full cost of the contract. Now, these are just separated basically by 1 unit. So one is in the strike and one is not, and they're the closest to each other. But the price is so different, $525 versus $290. So you can see just how powerful this is. If the price of Apple stock just climbs and puts the $120 strike price in the money, that $2.90 is going to jump up to something similar to that $5.25. And that means that you just make the difference between $525 and $290. You're making $235 on something you paid $290 for, just for a small price movement in Apple stock. And that's just if you buy one contract. If you buy 3 contracts, you're multiplying that by 3, and that's going to be something like a $700 gain for you. And that's where you really get that power of options from. So hopefully you guys are really starting to see how the leverage of options can turn those small trades into double your money trades, into those huge gains. And that's going to propel any trader into a whole nother level of income when they're using options correctly. Now, we've been over the introductory information for options. You now know the important terms on an options table and how to read those. So what I want to start doing in the next episodes of WSI TV for options trading is to go through some actual live examples so you can see yourself how within one day, within a few days or a week or a couple weeks, you can see these massive returns on simple price movements in a stock just because you're using the leverage and the power of options trading. But again, we're going to get to that in the next few episodes. Please feel free to review this one again just so you make sure you understand how an options trading table works, how to read it, and what that information is meaning to your trade. I'm really excited to get on to the next episodes of WSI TV to show you what's coming. But until then, Please enjoy these episodes, enjoy all the information coming to you from Wall Street Informer, and I can't wait to speak to you next time.
Thanks for watching another Wall Street Informer production on WSI TV. Be sure to visit wallstreetinformer.com, where you can become a member for free and gain instant access to the secrets of market millionaires via the Wall Street Informer Vault. So go ahead and claim this gift for free now at wallstreetinformer.com.